fixed rate debt, I don't have a problem with, as long as you have the ability to pay that debt off in a moment's notice. And that is the function of gold in my strategy. That's what I'm using it for. That's what others have used it for. So you've got to have a place to make your last stand. You've got to have a place that you can put in your food and your water and your energy and your security, as well as be part of the community. And it is your shelter. So it's a big part of the strategy. And as long as you can offset it, I see no problem in it. But as a speculation tool, this is ridiculous. This cannot go on forever. It can go on longer than you would think, so I can't tell you that it's going to end Tuesday morning at 8:35, but there are cracks that are starting to appear. You know, one of them is the CPI. Now, they want us to believe, the Fed chair wants us to believe that it's just transitory. Of course, his definition of transitory is a little interesting, as you heard the other day, but they're coming out and saying and talking about tapers. And they're coming out and talking about, well, when they talked about the taper, look what happened to the 10-year note yield. We are in an inflationary environment. When they wonder, will the Fed be behind the curve? The Fed is already behind the curve. The interest that they are controlling, the overnight interest rate, it's at zero, and they're telling you they're not going to raise it. Because after all, this inflation is transitory. Now, you can't define how long is transitory. A month, a year, 10 years, forever? Well, frankly, here's your transitory inflation, right? And this is official, which means you know that it's a lot worse than what we're seeing here, because they, through hedonics, they just change what's in that basket. So you are not being paid to take the risk. In fact, you are being forced out further on the risk spectrum. Can they raise these rates? Not with cratering the markets. And we got the news on the PPI. This is the producer price index. And guess what? It's surging too. Up from 1% year over year to 7.8% year over year. Now, not all of these have translated yet to the consumer, but can the businesses continue to eat these kinds of price increases? Yes, I'm not saying none of them have passed through the consumer. You know, you're buying food or water or you're buying anything and you see the price increases. But, you know, this isn't going to go away so fast. We may not necessarily understand exactly what the change is, but I can tell you, whenever there is a pattern shift, it means something. And so while it was being contained in here, right, just like the stock market, when you get technical, it all works the same. It really doesn't matter what you're looking at. And it was within a range, but that range has now broken out. What that tells me is that the next most likely outcome is for producer prices to continue to go up. So it'll be interesting to see what is done, because, you know, I really don't think that this is transitory. It hasn't been before. So, I mean, you got to ask yourself, what exactly does transitory mean? I guess if it ends in 2023 after a massive hyperinflation, or 2025 and we start all over, well, how long did it last? From 1913, you know, until whenever that time is, and that's transitory. Well, if you look at thousands of years, like gold has a history that goes back thousands and thousands of years, then, you know, 100 years or so would, I guess, be considered transitory. But if you're living through it on a day-to-day basis, you know, your income, chances are pretty good, for, at least I know this is true for most people, their income is not keeping pace with the rate of this inflation. And so even with the rate, with wage increases, it's still not keeping pace. But here's another piece that is potentially a crack. I'm not going to say absolutely, but I'm going to say potentially a crack. because liquidity is evaporating even before the Fed taper hits markets. Now, first, let's talk a minute about what that taper is, because are they going to be reversing any of the mortgage-backed security and treasury bond buying that they're doing? No. So that's not the taper. The taper is just buying a little less. So right now we're at 120 billion a month. And I don't know when they're going to buy a little bit less. And they say it'll be glacial, so maybe we won't notice. But let's see, a measure of U.S. financial liquidity whose declines foreshadowed two of the decade's worst equity routes is flashing alarms. I'm coming back to that. Even before the Federal Reserve embarks on its planned winding down of asset purchases. The signal is obscure, but has sent meaningful signs in the past, roughly speaking. It's the gap between the rates of growth in money supply and gross domestic product, an indicator known to eco-geeks as Marshallian K. It just turned negative for the first time since 2018, meaning GDP is rising faster than the government's M2 account. And I want you to keep in mind, financial shields are made of metal, not paper or promises. So I think it's really interesting that European investors, and this is a relatively newish development. They were sellers last month. Now they're net buyers. And they make it look like you actually get the physical when you buy the ETF, but all you have is a contract, and you have shares in a trust. In fact, the underlying gold or silver ETFs as well, is declining because they're selling off part of their holding to pay their ongoing daily management fees. You have a diminishing asset. But will paper really protect you from it? What do central banks buy? Central banks buy physical. Central banks around the world are anticipating an increase in gold reserves over the next 12 months, with most citing uncertainty over economic recovery from the COVID-19 pandemic as the reason for buying gold, according to a survey. Smartest guys in the room are buying gold for themselves because, frankly, they are super well aware of the fact that they are destroying the last vestige of value in the currency, and they can't stop.